Real estate investing can be a powerful wealth building strategy, but it can also be a daunting one when getting started. Well, rest assured, I created a 4-episode podcast series for you. Hi, I'm Adam Kemp, aka the Realtor for Hoopers, and I'm a Colorado real estate agent. In episode 1, we went through the types of real estate, benefits of investing, and the steps to getting started. In episode 2, we went through different strategies to invest, ways to get paid from buy and holds, and the 3 most profitable ways to invest. Go back and listen to those previous episodes if you missed them. In today's episode, we are going to go through the numbers to look at when you're considering to invest in real estate, as well as a simple way to evaluate your investment options. Here we go.
Realtor for Hoopers, welcome to the main event. I can never ride the bench, shoot straight, I don't miss. I got something special in my bag of tricks. Every time I flick the wrist, you can bet that it's a switch. Realtor for Hoopers, welcome to the main event.
Welcome to episode 3 of the Real Estate Investing Podcast Series. This is going to be a longer, more technical episode where we go through lots of numbers, formulas, and calculations. I'm going to try to make it as interesting as possible, but just know what you're getting into. So before we get into some numbers, I want to talk about the differences between qualifying for a loan on your primary residence, which is the one you live in, and qualifying loan for an investment property. Now, the main differences are down payment and debt to income ratio. So the debt to income ratio is your minimum monthly payments on all your debts, your car payments, your credit cards, your other mortgages, or anything like that, divided by your monthly gross income. So when you are qualifying for a primary residence, you can have anywhere from 5 to 20% down, and your debt to income ratio is a little bit lower. But on an investment property, there's just different minimum qualification standards on an investment property, because it's most of the time it's the second, third, or more home. So your down payment is pretty much going to need to be 20% and have a debt to income ratio of 50%. Now there's a different option called a DSCR loan. And this stands for debt service coverage ratio. Now these loans are meant for people trying to finance on a investment property. And how they qualify for that loan is what they think the property cash flow is going to be. And instead of using things like personal income, debt ratios, etc. So these DSCR loans do come with higher interest rates and closing costs, though. So keep that in mind. All right, now let's get into some numbers on buy and holds for investment properties. Obviously, the first one you need to keep in mind is purchase price. But make sure you include extra fees like closing costs as far as your purchase price goes. The next number is initial cash cost. So down payment, repairs, any furniture you need to buy, things like that. Number 3, operating expenses, taxes, insurance, HOA fees. A property manager can be 8 to 10%. And maintenance on the property can be 5 to 10% of your rent that you charge. The next number is net operating income, or NOI. Net operating income is your gross rent minus your operating expenses. The next number to look for is cap rate, which is your net operating income that we just talked about, divided by your purchase rate. Now, for a cap rate, you want to be around 6 to 8% or even more. That 6 to 8% is a solid cap rate number. The next number is cash flow. Cash flow is net operating income over your mortgage payment. Cash on cash return is your next number, which is your annual cash flow divided by your initial cash cost, which means you're basically just trying to say, like, how much of my return on that big lump sum cash that I put in the property to start, what's my return on that? And for that, you kind of want 8% or more to be your cash on cash return. Potential growth. Now, this is less of a monthly calculation and more of a over the life of owning this property. What is the potential growth I can have? What is the appreciation of the property? What is going to be my principal reduction from my renters paying down my principal as I'm charging them rent? Or how much can I increase the rent over the course of time? Is the rent going to be increasing in this area for this property over the course of time, or is it going to stay pretty stable? So now what I want to go through is I want to go through a basic example for these numbers. Okay, the property is 123 Main Street. The total purchase price was $450,000. The initial cash costs were $90,000 down, and you had to buy about $10,000 worth of rent. Now let's get into the operating expenses. The taxes are $2,500 annually. You're paying $250 a month for home insurance. There is no HOA, so that's good. You have $20 a month for renter's insurance, $500 for monthly maintenance that comes up throughout the year, and $400 a month for property management. Now, net operating income. For your gross rent, you're going to charge $200 a night on this buy and hold. And an average occupancy rate for the area is 70%. So gross rent would be around $51,100 annually. And for operating expenses, you're going to have about $16,540 annually of operating expenses. So $51,100 minus $16,540 is $34,560. This is your net operating income annually. Now, what is your cap rate? Remember, your cap rate is your net operating income divided by purchase price. So we have the net operating income of $34,560 divided by your total purchase price of $450,000, which equals 7.68%. So remember, we wanted a 6 to 8% number for a cap rate. So that 7.68%, it's a good number. Cash flow. So we want our net operating income minus our mortgage payment here. So our monthly net operating income, which would be $34,560 divided by 12, is $2,800. Okay. And the monthly payment on your loan would be $2,347 using current interest rates. Yeah, that's going to change if when you're watching this video, interest rates have gone up or down. But for this calculation, we're going to use $2,347 as your monthly payment. So your cash flow is that $2,800 of monthly net operating income minus your monthly payment of $2,347, which is $453 per month. Cash on cash return, which is annual cash flow divided by your initial cash costs. So your annual cash flow is $453 times 12 months in a year, divided by your initial cash costs, which were $100,000. So if you have annual cash flow of $453 times 12, which is $5,436, divided by $100,000, your cash on cash return is 5.44%, which we want 8% or more here. So that's a little low, but you still may go for this opportunity depending on these other numbers. So just because one of these numbers may be a little low, you can still consider this investment if all the other numbers are positive. Again, it's just up for your investment strategy and what risk you are willing to take. So again, our cash on cash return is about 5.44%. Now, get into the potential growth of this property. So average appreciation in that area that we're taking here is 5%, which means the home could be worth $472,500 after year one. So a 5% growth on a $450,000 property is $22,500. So that's how we got to that number. Now, you also charging your rent through your gross rent and all that you're doing here, your principal balance on your loan decreased by $3,780 in the first year, which means your potential growth for this property, just doing the appreciation of the property and your principal reduction, you could have around $115,000 in equity after year one, right? That's your $90,000 down payment, $22,500 of appreciation, and your $3,780-ish of principal reduction. So this looks like a good investment opportunity to me. So feel free to go back through these numbers if you want. If you have any questions on the details of these numbers, feel free to post a comment or send me a message. So now that we have gone through those buy and hold numbers to look for, I want to get into buy and flip numbers, because both of those are real estate investing strategies, but it can be very different as far as the numbers you need to look for when considering to invest in a buy and flip. So before we get into those numbers though, for a buy and flip strategy, let's go through the loan options. So the most common loan for what we're going to call a flipper is a hard money loan. So these hard money loans are 6 to 18 months in term. They have a higher interest rate, and they're based off of what's called your after repair value, which we'll get into here in a second. There are fix and flip loan options from specialty lenders like Lending Home, and they're similar to hard money loans, but they may have a lower interest rate. So look into those if that's possible. Another loan option that you have is a HELOC, or a home equity line of credit, using the equity from another property. So the benefits are you have a lower interest rate with the HELOC, and there's no third party involved, but you're risking another property and an asset for the basis of that loan. So using a HELOC is not recommended for first-time flippers. All right, so now let's get into the buy and flip numbers to look for. Some of these are similar to a buy and hold, but some of them are not. So buy and flip number one is purchase price. So make sure, again, to include any closing costs or fees associated with in that total purchase price. Number two, again, is initial cash costs. You can still have a down payment. You're going to have probably a lot of repairs, because usually when you're flipping it, you're renovating the property, so you have a high repair cost. You also might have some permitting costs. So you're going to need to work with your general contractor to get the full renovation costs with any permitting costs associated with the initial cash cost. And I would provide a suggestion here, maybe add 5 to 10% to that number, because things just tend to cost a little bit more than initially estimated. The third number is what we alluded to earlier, is the ARV, or after repair value. This is the value that you expect to get when you sell the home after all the renovation. So you're going to need to work the real estate agent or do a lot of analysis yourself to use for comps of like, okay, once we renovate this property and it looks this way and we have this repair done and all that, what is the potential sales price or after repair value of it? Now, the fourth number is carry costs. So these carry costs are very similar to the operating expenses that you used for a buy and hold. But since you're not constantly operating in the long term, like in a buy and hold, but you're not doing that for a buy and flip, that's why we call it carry costs for a buy and flip. So carry costs are any mortgage payments, taxes, insurance, HOA fees, utilities while you own the property and you are renovating. So for that 6 to 18 months or 3 months or whatever that time you are actually going to own and renovate this property, you're going to have some carry costs associated with it. The fifth number is selling costs. So any realtor fees, any closing costs, which are around 1 to 2%, etc. The next number is total project costs, which is your purchase price, your rehab / renovation costs, your carry costs, and your selling costs. That is your total project costs. Then estimated profit. So how you calculate your estimated profit is your after repair value minus your total project costs. Most flippers, like we're calling these wonderful investors, is most flippers want 10 to 20% of ARV as a margin for estimated profit. The next two are more conceptual and things you need to make sure you understand when you're doing a buy and flip is timeline. How long is it going to take you to renovate? That helps you calculate your carry costs. How long is it going to take you to get your permits approved? Some cities and states are faster than others. How long is it going to take you to sell that house? because that timeline is going to be a major part in understanding if this is a worthwhile investment for a buy and flip. And then last thing that you need to make sure you keep in mind when you're doing a buy and flip is, what is your exit strategy? What if the house doesn't sell? Can you refinance the loan and start renting it out and turn that buy and flip into a buy and hold? What are the options you have if this doesn't go well? We all want all these investments to go well, but they all don't. So you need to kind of have an exit strategy and what's your plan B if it gets to that point. All right, so just like we did for buy and holds, we're now going to go through an example property for buy and flip. Okay, the buy and flip property we are going to look at is 1111 Esther's Circle. The purchase price for this property is $400,000, including all closing costs and fees. The initial cash costs on this hard money loan that we're going to get are going to require us to do a 25% down payment, which is $100,000 down. And it's going to cost $50,000 in repairs and permit costs. After talking to a real estate agent, the after repair value on this property could be $575,000. I'm going to go into timeline now because that's going to be a catalyst to the rest of the numbers. So when we're looking at this property, it's going to take us 2 weeks to get our permits, 4 to 6 weeks for the renovations to happen, and it's going to take 4 weeks to sell. So that's about a 4-month time frame. Okay. The carry costs for this are what's our monthly interest only payment on this hard money loan. It's going to be $3,000, $200 per month for home insurance, $300 per month for property taxes, and utilities are $100 a month. And again, we found a property with no HOA monthly costs or anything costs. Selling costs. So realtor fees, we're going to pay 2.5% to the listing, 2.5% to the buyer's agent. So that's going to be 5% total, which is $28,750. And the closing costs are $8,625. So our total project costs, purchase plus rehab plus carry plus selling, is $400,000 of purchase price, $50,000 for rehab, a 4-month carry, which means we're going to have a $14,400 in carry costs, and we are going to have $37,375 in selling costs. All that totals up for a total project cost of $501,775. Estimated profit. All right, our estimated profit is our after repair value minus the total project cost. So our after repair value was $575,000, and our total project cost was $501,775, which that means that our estimated profit is $73,225. If you divide that by the ARV of 575, you get a 12.73% estimated profit. So we want 10 to 20% as a margin. So that 12.73% works for this investment. So this looks like a pretty strong investment, depending on your investment strategy and what you would like to manage and all of that. But like I said, before we move on, what's our exit strategy? With this property in this area, we are very, very confident that we're going to be able to rent out this place and turn it into a buy and hold if the property doesn't sell in either that 4-week time frame, or we're just not getting the values that we're wanting for our after repair value. So we are going to keep it, we're going to rent it, and we're going to try to refinance our loan into a more conventional mortgage loan instead of a hard money loan. All right, so now we are going to get into a simple evaluation strategy for all of these investment options. So you're going to have lots of investment options besides just real estate. You have stocks, you have cash, you have real estate. So I want to go over a simple evaluation tactic I use to consider where to put my money and how I want it to grow and how I can diversify my portfolio as a whole. I got this technique from Sharpen. He says that there are 4 pieces of a potential investment that you need to understand: capital preservation, tax efficiency, cash flow, and growth. So let's go through these. Capital preservation. How likely is it that your initial investment is going to be available to you 5-10 years? Tax efficiency. What are you going to be taxed on? Are there any tax advantages to this investment? Cash flow. How much income is this investment producing for you on a monthly or annual basis? Growth. Is this investment increasing in value as you hold it or as you own it? Once you understand these 4 pieces, Sharon says that you should get a score of up to 25 for each piece for the investment. Once you do that, then you'll have a total score up to 100 for that potential investment for you. Then you can decide for that investment and for this time and what you're wanting for you and your family, if that's the investment that you're going to go with. So let's go through some options: cash, stocks, and real estate, and go through these each 4 pieces of a potential investment. Cash. Well, for capital preservation, it's a pretty high score. So let's go with 25 for capital preservation for cash. Tax efficiency. And you'll be taxed on your, when you initially made that, but there are no tax advantages to cash. You're not going to be able to do depreciation or anything like that. So, we'll give a tax efficiency score of 5 for cash. Cash flow. This cash is not producing any income for you because you just have it sitting there in your bank account. So that's a 0. Growth. Is it increasing in value? Nope. It's just sitting there again, right? So your total score for cash is 25 for capital preservation and 5 for tax efficiency. So we'll give cash a score of 30. Stocks. Capital preservation. Well, there is a little bit of risk that the value of the stocks or mutual funds or anything that you're investing in go down in value. That's kind of atypical. So how about we give it a score of 20? This is just an objective score that you give it for yourself. This isn't just a standard thing. Tax efficiency. Well, you're going to be taxed on long-term or short-term capital gains. There aren't any tax advantages to owning stocks. So I would say let's give that a tax efficiency score of 10. Cash flow. Stocks are going to be producing income for you on a monthly and annual basis. So let's give that a score of 15. Growth. The asset is going to be increasing in value. So we'll go another score of 15. So we did capital preservation of 20. We did tax efficiency 10. We did cash flow and growth of 15. So that would be a total score of 60. Now let's get into real estate. Capital preservation of real estate. How likely is that initial investment going to be available? So your initial investment of your down payments, your things like that. Once you have the equity in the house, you always have that. So I would say that we're going to give that score of 20 for capital preservation. Tax efficiency, you are going to be taxed on long-term capital gains, but there are tons and tons of tax advantages to real estate. So we are going to give that a score of 20. Your cash flow, it's producing you income on a monthly annual basis. So we'll give that another score of 20. In growth, in most areas, homes appreciate in value. There are some areas where they kind of are stable value, or there is a risk that it could go down in value overall. So maybe let's give that a score of 15, 20 for others, but we'll stick with 15. So for real estate, we're going to have a total score of 75s. 20 plus 20 plus 20 plus 15 is 75. So for my personal evaluation of these investment options that I have, I would choose to invest in real estate because that has the highest score out of 100 that you can do. So I really, really appreciate you tuning in to episode 3. Thank you for staying tuned for this longer, more technical episode. But I wanted to get through some numbers so some people can actually start doing evaluations for themselves. And it's not just a conceptual idea without having to do some evaluations at home. If you have any questions or if you want to connect with me, reach out on social media at Realtor for Hoopers, or you can always go to my website at www.realtorforhoopers.com.
On top of the game, we not one and the same. I'm Stephen Curry, the range. I Allen out with the cross. I'm Kobe Bryant, the fade. I'm one that's calling the plays. Now what else more can I say?